for those aged between 25 and above. The reason I'm doing it is because we are surrounded by all sorts of myths right now about investing in forex, investing in crypto, investing in all sorts of bonds, investing a little bit everywhere, in all sorts of schemes, not really knowing what to do, not really understanding the concept behind, and not really having like freedom for money. So let's dig in the content. We're going to introduce investments. I'm going to talk about retail banks, bonds, stocks, cryptocurrency, which are some fields where you can invest your money. And I'm going to classify your different investment needs. As an introduction, investment is a widely studied problem in mathematics, finance, and computational literature. Through portfolio diversification and other portfolio problems, whereby you need to not lay all your eggs in one basket. Institutions and individuals need to plan their future investments to fund retirement needs, future liabilities, endowments, children educations, and other goals. So examples of institutions, you have universities, banks, investment funds, pension funds, among others. The goal and the objective is to build a fruitful investment strategy as a long-term goal so that you have freedom for money. What I mean by freedom for money is that no relation with money is associated with trauma. So you see that many people have that trauma with money because they don't have a stable job. They are worried about the education plans of their children and other occurrences. So in the end, the concept of investment should make you have no trauma. Where to invest? You have pension funds, banks, stock market, bonds, cryptocurrencies, startups, equity, and index funds. Okay, so the concept of retail bank, it is a secured fund. It takes deposits and gives out loans. It usually takes deposits at a cheap rate and give out loans at a higher rate, which is borrow at cheap rate and loans at higher rate. This is how a bank creates money. That is, when you lend you lend the bank money, and the bank gives out loans through mortgages. So this is a creation of money concept being done here. So the banks create money and it appears on the account of the borrower. Can banks, okay, so banks operate the payment system in an economy, but can banks, okay, the interest gain is risk-free because it is a secured fund, which is a passive income. Okay, so your money grows when you make a deposit in the bank. You'll have you gaining interest. Can a country actually operate without banks? So this happened in the Irish banking strike in 1970, whereby pubs were being used. Okay, so what were done by the people at the funds is that you would write a piece of paper, that is a check, give the barman a check in the pubs, and the person in the pub knows you and knows you personally and knows that yes, you do have that money, and so he gives you the benefit of the doubt, if I might say so. And this is how pubs were putting checks back into the economy, and you had a newly created money. Okay, but however, this was not this was that pubs were unable to come to save when the Lehman Brothers uh, were falling. So pubs did not bail out the Lehman Brothers. Since we're talking about banks, let's go a little bit back in history about the idea of the banking system. So this happened in 1789, whereby you had a woman called Priscilla Wakefield, where she noticed that servants and those earning that is the persons like the middle class person had no place to store their money, that is the normal money that they earned while working. So in the end, she offered to put the money in her safety bank with 5% rate as interest. So the common people started saving and with her, and this is how the idea of banking started in England, especially. Next, we are going to talk about the bond market. So, a bond is a promise to pay a certain sum of money at some known time in the future. So, I might promise to pay you $100 at time T, but were you willing to um, take a would you willing to buy my bond, knowing that you would rather prefer a sounder bond, that is somebody who has more credibility, that will not default. This is why we have government bonds here, which will come into play. That is government bond and yields, that is, we will last for a very long time. So government, okay. So why does so you buy a bond from the government and the government borrow money from you for employing benefits, especially during recession? Okay. So how does a government raise money? It sells bonds or raise taxes. Buyers of government bonds are usually pension funds. That is in order to ensure long-term liability. Government raising taxes to pay for employee benefits during recessions or to pay for rights in healthcare. Okay, so what happens when consumer confidence decreases? You have the bond price decreasing because people are no longer confident about the government. So therefore, the rates will increase. So the central banks may have to intervene to buy government bonds and to put everything back into place. Okay, so that rates are decreased again. Other bonds, you have corporate bonds, that is bonds issued by a corporate company. And next we have stocks, so private shares, that is private corporations issue shares, not for a public stock exchange. Each shareholder is entitled to the slice of a pie, that is a profit. Okay, and you receive that profit, I think, in the form of dividends. And then you have shares sold to public through the London Stock Exchange, the New York Stock Exchange, in Mauritius you have the SEM. So you have to understand the different market orders, limit orders, and stop losses in order to understand the concept of trading. And you need to know in which types of market you want to trade in, whether you want to trade in the bull, the bullish, or the stag market. Otherwise, you can invest in an index fund, that is S&P 500, Dow Jones, or Santen, or create your own basket of your own portfolio of securities that you believe you want to hold for a certain period of time. And then you have the concept of cryptocurrency, where I have talked about before. Okay, so the cryptocurrency is a risk asset which experiences period of rise and subsequent fall off in value. The increased use of transactions at the start and rapid growth at the beginning, especially at the beginning of COVID-19, where you found that crypto were doing really well. And the early investors saw exponential gains, that is, fast returns, continued attracting new investors, thus creating an overhype. So in the end, the exploration of blockchain technology, updating cryptocurrency transactions, and overall attention focused in digital assets caused fears of over-speculation and contributed to the decline of the risky asset, making it a bagel land. Right? And of course, you have other asset classes, which are gold, platinum, and precious metals. Gold ETFs, that is exchange traded funds. You can have fixed income also, and then you have property, whereby rent is being a secured fund. Okay, and now I had said that I would classify the investment needs with respect to the age group. So the first age group that we have, which is the 20s to the 30s. So this is a stage where you're usually hit by a quarter life stage crisis. You have a career uncertainty. You don't know whether this is the career that you want to follow. You might have a relationship uncertainty. Also, you might not know if this is the person you want to spend your life with if you're ever dating someone. Yes, you are free at this age. You have no dependent and no full family. And that is something that you might want. No big responsibility. You just living casually like this. And you cannot overemphasize saving over lifestyle, because at this stage you need your mental health, you need to focus on yourself. So instead of really getting to the concept of saving and all those huge responsibilities, you could go for that holiday, you could make a foreign trip, you could buy a luxury product that for example, a watch you've dreamt about having, or the pen you saw in a beautiful mind. You just go for it, okay? Because this is the age of actually making mistakes. But yeah, you can't make an irreversible mistake also. Okay, do not make unrecoverable mistakes. This is the time when you make good friends, because those are the ones who will help in damping the shocks you get from life. And then you need to set good behaviors. You practice a sport, you listen to podcasts, and you listen to spiritual things. Okay. And then I have merged 30s and 40s and the 40s and 50s, where you get to wake up and plan your day, because you're gonna have a lot of responsibilities. Okay, because this is the age group where you have actually grown from the immaturity of the 20s, and you have actually grown from the quarter life stage crisis also, and you might just going to be in a middle stage life crisis. So yeah, the family grows, you have a career building phase, you have bigger debt issues because you have loans and education plans for children. So you need to identify your financial trauma, whether you have a high risk job where you go in the morning and may not return in the afternoon, and set your beneficiaries and dependents, whether you want to plan for the education of your kids, whether you have loans to pay. All these things come into play. And next is the concept of if you're really at ease at this age, you have a stable job, you can go for an aggressive investment strategy that is a tactical asset allocation. If you are rich, you can do it. You can invest in some portfolio or invest in the capital markets. Okay, but before actually going for any kind of investing, you need to define the mistakes that you cannot afford and protect your downside. That is, create a stop loss limit. And then you can also select a life insurance or a pension scheme based on your financial trauma. So, like I said before, if you have a high risk job but you go in the morning and may not return in the afternoon, if you want to take a medical insurance, a life insurance, or any such thing, and then you get to wake up and plan your day. Above the 50s, you have a high accountability of income, which is healthcare and leisure, whereby you are going to retire. That is retirement. Retirement is you having little change in your pocket, good health, and somebody who cares about you. It's not about driving huge Ferrari and enjoying your life, because at that time you you are very fragile and weak, and you might need money to cater for your health and for medical treatment. You can take the work optional option. It is a part-time job that caters for your social life and keeps you happy. Like Bob Iger, I made a little video where I talked about Bob Iger's work optional. And the last conclusion is invest in yourself. Nobody can take away what you've got in yourself, and everybody has potential they haven't used yet. By Warren Buffett. So that's all for concept of investments for 25 and above.